Thank you. We'll call the Investment Committee of CalSTRS to order. Mr. Holtz, would you please take the roll?
For the Director of Finance, Ms. Whitaker.
Ms. Bradford, Department of Finance.
What was that?
It's Michelle Pearl on behalf of the Director
your name is
Stephen
wrong
Shaw.
there, sorry.
It is, it's
Sorry.
okay.
Sorry
We
about
did
that.
that was our fault, not yours. Thank you, but present.
For the State Controller, Ms. Gallegos.
Present.
Mr. Tang.
Present.
Ms. Yamamoto.
Present.
Ms. Bradford.
Here.
Ms. Hendricks.
Here.
Mr. Gunning.
Here.
And for the State Treasurer, Mr. Henning.
Here.
Chair Keeley, you have a quorum.
Thank you, sir. I think there's something to be read into the record. Thank you.
The CalSTRS board meetings are live web streamed, video archived, and available to the public on calstrs.com. Individuals who wish to address the board should wait for the 10-minute public comment period at the end of the agenda item the speaker wishes to address. For comments not pertaining to a specific agenda item, there will be an opportunity for additional statements at the end of the open session. Each speaker is allowed a maximum of 3 minutes to comment. However, if there is not enough time for each speaker to have 3 minutes, the timing will be at the discretion of the chair. To protect the privacy of speakers under the age of 18 who wish to address the board, only their first name and affiliated organization may be provided, but other personal identifying information such as their last name, age, or school may not be shared. Back to you.
Thank you, sir. So I'd look for a motion to approve today's agenda with some flexibility.
Motion to approve.
Thank you. It's been moved. It's properly seconded without objection. Today's agenda has been approved with some flexibility. Our next item is opportunities for statements from the public. Samantha, do we have members of the public to speak with us today?
We do.
Okay.
So we'll put up a 3-minute timer for our public commenters. We will start with in person. Our first speaker will be Jared.
As our first speaker is coming up to address us, as you can see across the screens in the boardroom, as also in the stakeholder room and on our screens was a quote from the CalSTRS Investment Committee policy on why we're here and our primary purpose. Sir?
Good morning, Chair, members of the board. My name is Jared People, researcher at the United Kingdom Commercial Workers Union. I'm here to speak about Cardenas Markets, a California-based grocery chain owned by Apollo Fund 9, a fund CalSTRS has invested $300 million in. We believe that Cardenas' labor record poses a risk to your investment through litigation and a protracted labor dispute. Cardenas has settled 3 class action lawsuits in the last 3 years alleging violations of the California Labor Code at a total cost of $10 million without admitting wrongdoing. Allegations include pay and overtime violations, rest break violations, failure to reimburse employees for safety shoes, or failure to provide seats for cashiers, among others. The most recent of these settlements occurred in March of this year, covered more than 10,000 employees, and included allegations similar to those covered in a 2021 class action settlement. These recent class action lawsuits alleging similar violations suggest that company practices have resulted in a heightened risk of workers alleging employment violations. Since we last came before you, Valeria Alvarez, who spoke to you last November about her experience at Cardenas, filed suit alleging claims under California's Fair Employment and Housing Act of sexual harassment, retaliation for reporting sexual harassment, and wrongful termination, among other allegations. Cardenas also has 4 outstanding labor practice charges filed by UFCW with the National Labor Relations Board alleging workers were discharged on account of their union or protected activity. We commend CalSTRS' inclusion of workers' rights in your ESG risks and your inclusion of equal employment and the right to organize a union on the job in your statement of share owner ESG responsibilities, and we believe that Cardenas is a prime example of why you need to apply strong labor principles to your private equity investments. Apollo knows how to protect its investors against labor risks. For example, Apollo negotiated a neutrality agreement with 3 unions at the Venetian Casino in Las Vegas, also a portfolio company of Apollo Fund 9. A neutrality agreement protects investors and workers alike by guaranteeing that workers can exercise their right to join a union or not without management intimidation in exchange for limitations on labor actions during organizing. In the case of Cardenas, Apollo has instead abdicated its responsibility to protect your to protect you from labor risk, telling UFCW leadership that portfolio companies operate independently and Apollo can't tell Cardenas to change its approach to labor. If a neutrality agreement is the right course to protect your investment from Las Vegas labor risks, then we urge you to ask Apollo why you should not be protected the same way from labor risks right here in your home state with Cardenas Markets. We urge you not to make any future commitments to Apollo funds until Apollo holds itself and Cardenas accountable to your investment policies, to California's strong labor laws, and to workers' rights on the job. Thank you.
Thank you for your comment.
What's your first name, sir?
Jared Gaby Beagle.
Jared. Mr. Chan? Scott, is there a staff member that Jared could be directed to? And then we'll follow up with the staff to get a update.
Yes, and of course, we take all labor practices and matters seriously. We're engaging our managers. Tom Baker has really been monitoring and doing a lot of the reporting.
Great, thank you, Mr. Chan. And Mr. Holtz, would you make a note that we'll ask for an update at our next investment committee meeting in closed session on the engagement that staff has had on this matter?
Will do.
Thank you, sir. Samantha, our next public comment?
Our next speaker will be Eric.
Good morning. My name is Eric Lerner, and I work with the Alliance of Californians for Community Empowerment, otherwise known as ACE. We have 18,000 members in California, mostly low-income people of color, who are on the front lines of fighting for housing justice as a result of living in the buildings owned by big corporate landlords. I'm here today to talk about CalPERS investments in Thoma Brava Fund 13 and 14, which bought a company by the name of RealPage. As you probably know, RealPage has been accused of colluding with corporate landlords in a cartel that artificially inflates rental prices, transforming the housing market and creating monopolies that can lead to extreme and illegal rent hikes. Over 30 lawsuits have been filed against RealPage, including by the U.S. Department of Justice, together with 8 state attorneys general. The Department of Justice's press release accuses RealPage of having harmed millions of renters in the United States and of operating an unlawful scheme to decrease competition among landlords in apartment pricing. This software is enabling some of the biggest Wall Street corporate landlords, like Blackstone, who you're also invested in, to rig prices. The San Francisco Board of Supervisors has banned the use of the software, and the San Diego Board of Supervisors has passed a proposal to rein in corporate landlords who are using the software. We know you care about the harm being caused by so many Californians by the housing crisis. When housing becomes unaffordable for CalSTRS members, retirees, and working people because of bad actors like Thoma Brava, it's time to take action. That's why we're asking you to meet with CalPERS staff to discuss ending investments in Thoma Brava Fund number 13 and 14. Thank you.
Next public comment?
Our next 2 public comment speakers will be over the phone and will also be using translators, so they will get a 6-minute timer.
Thank you, Samantha. Thanks, Samantha.
We will take one and their translator, and then we'll pause to reset the timer and take the next one.
Thank you.
So our first speaker is Maria. Go ahead, Maria.
Hello, good morning, members of the board. My name is Daniel Garcia. I'm here with Maria. She'll be giving her testimony and I'll be translating it after.
Yo soy María Vargas. Tengo 72 años. Trabajo en Cárdenas durante casi 8 años. Y en la mayoría del tiempo he trabajado en la cocina. Después de todo el mes de agosto me pusieron a trabajar en... Los gerentes se aprovechan de mí porque no sé leer ni escribir. Después de este mes de agosto, después de 3 años de no tomar vacaciones, solicité una semana de vacaciones y solamente me dieron 2 días. Y no me pagaron esa semana hasta la siguiente semana. Entonces, cuando vi mi cheque corto, fui y le dije a la gerente que por qué me había llegado mi cheque tan corto. Y me dijo, no, que no sabe leer ni escribir. Le dije, no sé leer ni escribir, pero no soy ninguna tonta. Y había otras 2 personas más y se comenzaron a reír. A principios de este mes de agosto me cambiaron llegó uno de recursos humanos y le dije que si me daba una tarjeta. Y una de las supervisoras me buscó y me dijo, ¿para qué quiere recursos humanos? Que usted no sabe que lo que se hace aquí no lo debe de decir a nadie. Nos hacen sentir mal a las personas mayores, como nos discriminan mucho. Entonces nosotros nos sentimos mal porque pues no sabemos a quién apegarnos. Ahora estoy en mantenimiento y me sacan afuera a puchar carritos cuando está el sol tan súper caliente. Y para mi edad yo ya me siento muy mal. Nos ponen a las personas más mayores para que nos enfademos y nos vayamos. Creo que Cárdenas nos debería de tratar con un poquito más de respeto. Creo que la inversión en Apolo sería mayor si nos valoraran por lo que aportamos. Incluso al final de nuestras carreras laborales. Gracias. Gracias.
Okay, thank you. And I'll be translating that for you guys. I am Maria Vargas. I am 72 years old and I have worked in the same Cárdenas market store for almost 8 years, most of that time in the kitchen. Managers take advantage of me because I cannot read or write. For example, after 3 years of not taking any vacation, I put in a week of vacation. All they approved was 2 days. They paid me for those 2 days, but not until the week after I took the vacation. And that week, my paycheck was very short. So around August 10th, I went up to the office where the administrator was with 2 other women who are also supervisors. And I asked her why I had so little money in my check. She replied, "No, you can't read?" I replied that I couldn't read or write, but I'm not stupid. And she and the other 2 women laughed. Earlier this month, when a human resources person was visiting our store, I asked for his card. The second store assistant manager saw me when I was with human resources and spoke to me to scold me and said, "Why did you ask human resources for the card? You don't have to tell me what's going on here." Managers make us older people who work there feel that we are no longer useful. Since August, I have been in maintenance and I have to push carts outside where the temperatures reach more than 100 degrees. That makes me feel bad for me to endure those high temperatures at my age. I think they put older people in that job to get us to leave. I think Cárdenas should treat us with respect, and I think your investment in Apollo would do better if we were valued for what we contribute to the company, even at the end of our working careers. Thank you.
Thank you for your comment. Can we restart the timer, please?
Yes, I will also be translating for Melchor Lucatero.
Okay. Or let us get the timer restarted and then we will take the next speaker. Okay, our next speaker will be Melchor. Go ahead.
Sí, muy buenos días. Mi nombre es Melchor Lucatero Torres y estoy llamando para compartirles mi experiencia en Cárdenas para que puedan entender mejor su experiencia en Apolo. Tengo una incapacidad de epilepsia y trabajo muy duro afuera en los carritos, adentro, hago de todo. Una ocasión tuve una emergencia médica porque una supervisora empezó a aventarme flores, empezó a agredirme y me sentí muy humillado y y al siguiente día me recuperé. Entonces, pasó como unos 3 días, 1 semana, y mis horas empezaron a bajar de 38 horas a 30 horas, y entonces yo le compartí al gerente, al presidente, que yo necesitaba mis horas para pagar mi medicina, y me dijo, mira, pues ese no es mi problema, y yo me siento muy decepcionado por eso, porque yo he hecho muchas cosas por ellos, y, y una ocasión le dije al de recursos humanos pues que no se me hacía justo lo que yo ganaba, porque gano 16.40, le dije que por favor, pues mucha gente gana mucho más de lo que yo gano, y van entrando, y le dije que yo ganaba muy poquito, y él me dijo que mi trabajo no valía, y pues me quedé como en shock, me quedé muy mal, y pues como los trabajadores de Cárdenas, podríamos hacer mejor trabajo para su inversión en Apolo, si fuéramos tratados como seres humanos, y tal vez no como animales. Muchas gracias.
Good morning. My name is Melchor. I am calling in today to speak about my experience as a worker at Cárdenas Market so you can better understand your investment in Apollo. I have epilepsy, so I'm disabled, but I work hard. One day I had a medical emergency after a supervisor threw flowers at me because she was mad. I felt humiliated. After I recovered, my hours were cut from 38 to 40 hours a week to 32 hours a week. When I told my manager that I needed the hours to pay for medicine, he said that was not his problem. I am disappointed that they do not want to give me more hours since I know other workers who get extra hours. I earned $16.40 an hour. About 6 months ago, I told HR Human Resources that they pay me very little, and he told me that my work is not worth it. I think Cárdenas workers could do a better job for your investment if we were treated as human beings. I'm speaking up to change how the company treats us, for us and for your investment. Thank you.
Thank you for your comment. That is the conclusion of public comment for item 2.
Thank you, Samantha. And before staff tees up our video, just a couple of comments. One, I want to thank on behalf of the board and the investment committee, the members of the public that took time from their day to come and speak to us here personally or called in. Secondly, we as a board in this organization believes that every human being deserves respect and dignity. They must be treated with respect and dignity. We as an investment committee delegate to our staff to ensure that they communicate with our partners how we think people should be treated. We've asked members of the public who have come here and have testified to follow up with our staff with the concerns that you've raised. We have as an obligation to ensure that there's a circle of accountability. We will do what we can within our authority. And if you read that statement, our purpose, our mission, our fiduciary responsibility. And there's a lot of gray space between the testimonies today and what our purpose and mission is. We can do certain things that we can do, and we will do those things to ensure that our values, our mission, our purpose, how we want people to be treated is communicated with our partners. There are other things that we cannot do, that we're prohibited from doing by law. Many of us have negotiated labor contracts in our careers. We understand the struggle. We're not in that position today. We have a solemn responsibility to make sure that we're paying pension promises. At the same time, we can communicate to our partners that the firms and the companies that they control espouse those same values. And we will ensure that there's a circle of accountability, that we get reported back as to how our staff is engaging with our partners in the appropriate way. So I want to thank you again on behalf of the board for coming and testifying today, and also for your understanding that there are certain things that we cannot do, that we're prohibited from doing, that we won't do. But what we can do is we will engage with our partners and make sure that they are promoting and advancing principles and values that holds every human being with the utmost respect and dignity. Can we go to our video, please?
My name is Anselmo Marin, and I'm entering my 17th year as a teacher. I currently teach middle school science at Elkhorn Village Elementary School in West Sacramento, California.
My name is Julie Law Morin. I'm a social science teacher at Antelope High School in Roseville Joint Union High School District, and I've been teaching for 13 years.
We met in 2014, teaching together, and we've been now married for 7 years, and we have a son. So my son's name is Nico. He's 10 months, and I like having his pictures up there to remind me what my second job is when I get home, and who I'm missing.
I became a teacher because I had so many great teachers in my life. Teachers made me feel like I belonged at school. I remembered the comfort that my preschool teacher had for my parents because they spoke the same language.
And I became a teacher because it gave me the opportunity to give back to the community, to help people, to help them understand things. Specifically as a science teacher, because I have a love and passion for science. Back here, I have a lot of the projects, or some of the projects that students do for MESA, Mathematics, Engineering, Science Achievement.
A few of my students have now become nurses, and they said it was from career day in 6th grade that made me realize I want to be a nurse.
I had a former student, or have a student right now who's a senior this year. As a 6th grader, he started collecting cans around the school. He was collecting cans to save up for clippers and scissors because he wanted to become a barber. So I actually took him over to my barber, introduced him, and they got to meet, and he got to just interact with another barber. Now as a senior, he's thinking about going into barber school.
Our goal isn't for them to want to like science or history as much as we like it. Our goal is to help them find that thing that they're passionate about, that sparks them, and watch them gravitate that and build on it over the years.
My connections with my students doesn't just stop at the classroom. It starts in the classroom, but it continues on through their high school years and even through their college years and through their adult life.
I went to this profession at 22. At 22, you have no idea what life is gonna look like. And you don't know how to plan, to be very quite honest with you. Knowing now that I actually have something in place for retirement is so much more of a relief than being like, I have to start planning now and start figuring it out. You also think when you're 22, I'm gonna live forever. I don't need to worry about retirement. And so having that benefit now provides me a sense of, I can do the things in life that I enjoy for things for myself, my family, my son, and not worry as much.
Anything that you can do early on is gonna help you that much more later. So it doesn't have to be, exorbitant amount of savings or things that you're doing early on, but as long as you're starting to put something away, it's gonna be that much more beneficial for you in the end.
We like going to national parks. There are certain times of the year national parks are great. Other times of the year they're not. So in retirement, hopefully we'll be able to accomplish going to all of them. I've been trying to get him to go to Death Valley with me, but he keeps telling me it's never cold enough for Death Valley.
We're not going in July.
So we've also like to travel different states, and so being able to maybe eventually hit all 50 states is something.
Just about every month, I log into the MySTRS website just to double check that everything on the district side has made it here. Any extra hours that I work or that we work as educators will go into a supplemental benefit as well. Having that at the end is a sense of confidence and relief. I've done, my teaching career, and now I can go into the next chapter of my life, and that's going to be waiting for me.
Another great video. Thank you to those who made it possible. Which brings us to our business of the day. We have our semi-annual reports, starting with the general consultant Makita's report, followed by our real estate semi-annual report, followed by private equity. I'll turn it over to Steve and the team. And for the purpose of process, we'll allow the presenters to present their reports first, and then we'll take questions after. Steve, I'll turn it over to you.
Great. Thank you, Chair Keeley. Steve McCourt with Makita Investment Group. I have with me up here Stephanie Sorg and Mika Malone as well. You have in your packets a much more detailed report from Makita. We'll be reviewing today a brief slide presentation to highlight some of the summary takeaways from our report. Just to remind this committee the context for the semi-annual reports, you have delegated to staff the responsibility to invest the assets of CalSTRS. You retain the responsibility as a committee to monitor that authority that you've delegated. And so these reports provide you documentation of the monitoring and oversight work that Makita has done on your behalf over time. As you know, Makita integrates with staff on more or less a daily basis across your asset classes and strategies. So from our perspective, we have a very strong sense of activity at all times within your investment program. We supplement that for these reports with a semi-annual process of providing RFIs to each of the asset class heads of the program, and we interview each of the asset class heads as well in our preparation of this report. The report itself simply represents a summary of our findings, which we present to you once every 6 months. So with that, I'm failing to advance the slides here. There we go. Let me just highlight the key takeaways. At the broadest level, Makita believes that staff continues to execute at a very high level on your behalf, and our measures for evaluation continue to be overwhelmingly positive over relevant time periods. The performance of the investment program through June 30th for the trailing 1-year period was 8.4%. That exceeded the return of your policy benchmark by 1%. It was 2.2% below the return of the median public fund, over $10 billion, and a bit more below the return of your reference portfolio. And as a reminder, that portfolio is a simple mix of 70% global equities and 30% fixed income. I'll note that the reasons for the 8.4% being below the return of both peers and the reference portfolio for the 1-year period are the same reasons that your portfolio has generally done better than peers or the reference portfolio over long periods, and that is a higher allocation to private market asset classes. The trailing 1-year period is a period where the equity markets, public equity markets in particular, did significantly better than private markets. Over the trailing 10-year period, your portfolio returns 7.7% per year, 40 basis points ahead of the policy benchmark per year, 20 basis points ahead of the peer pension plan over $10 billion, and 140 basis points per year higher than the reference portfolio.
Great. Good morning, all. Stephanie Sorg with Makita. So turning our attention to CalSTRS' 2 largest public asset classes, you'll see on the page here, we've got global equity on the left-hand side and then fixed income on the right. Collectively, these asset classes make up over half of the total portfolio and thus are meaningful drivers of overall performance. And what we show on this page are the trailing 5 and 10-year returns and then risk-adjusted return measurement known as the Sharpe ratio for those 2 asset classes, and then a set of relevant comparables. And we show the 5 and the 10-year periods because it gives us a good idea of how your portfolio would have looked and acted over a market cycle here. And so when we take a look at the top left table for global equity, you can see that the portfolio over the 5 and 10 years returned an annualized 10.7 and 8.9% respectively. Compared to the policy benchmark, the MSCI ACWI IMI, which is an industry benchmark for the entire universe of global equities, and then your peer group median here, you've outperformed over both time periods, all 3 measurements. When we dig into some of the details, those positive marks are stemming from underlying results that are positive within US equity, non-US developed equity, and emerging markets equity. Those have all posted positive absolute and relative returns over the measured time periods here. What the bottom table tells us is that global equity as an asset class has been able to produce those superior returns while assuming less risk. And so that means that they're having a higher Sharpe ratio, which is indicated in the table here. It's positive, and it also outperforms all 3 underlying benchmarks there. Moving to fixed income, the good news keep coming. Over the 5 and 10-year time periods, you can see the asset class with a return of 0.4% over the 5-year and 1.9% over the 10-year time period, outperforms the majority of the comparables here, that policy benchmark and the Bloomberg aggregate, lagging a little bit that peer group median, but when we dig into some of the underlying components of the peer group, they had a higher allocation to higher yielding assets and credit, and we've not seen that cycle play out just yet. When we move to the Sharpe ratio table just below, favorable marks for the asset class, outperforming majority of comparables there. The positive marks here are going to be the direct result of your staff staying disciplined and skillfully navigating a tough market environment, which included a pandemic, inflation, geopolitical tensions, monetary tightening, and more recently what we've seen is the strong run of the Magnificent Seven. Both asset classes still managed to produce positive relative returns here.
Second. So thinking forward, as Stephanie and Steve just highlighted, a lot of positivity in the results of the CalSTRS pension fund looking backwards. We want to think, what are the risks that your pension fund will face as we look forward? So this first slide and what we're calling some of the big risks in the capital markets going forward, and we have a question mark here, the US consumer, are they under stress? So first, before we kind of talk about the visual sight test that we have in the 3 charts below, I wanted to just highlight, why is it important what's going on with the US consumer? And if you think about the contribution of the US consumer to GDP growth in the United States, it's about 70% of those numbers. So when we think about the resiliency in the economic backdrop that has produced those returns that Stephanie just highlighted, that is driven, 2/3 of that or more is driven by the spending that consumers have been doing. And they've been doing that in the face of higher interest rates over the last several years and a backdrop of inflation for the first time in many of their spending lifetimes. So the economy has relied on that resiliency to see the returns that we've had. And the question going forward is, how long can the consumer sustain that level of spending to drive growth? Or are we faced with a potential decline in that and therefore a higher risk for recession? So I know these are things that we all see in the news and you hear about quite a bit, but we wanted to put a few points out to kind of highlight where some of those cracks could potentially come from so that we're aware of what those risks look like. So we have 3 charts on the slide in front of you and for everyone in the audience. On the left, what we're looking at here is liquid wealth that households have relative to kind of a no pandemic estimate. So what was expected in terms of growth if there hadn't been a pandemic, and that's the dotted line, the projected path of wealth. What you see is kind of in the center of that left-hand chart, a big spike up early in the pandemic. And if you recall, all of the news headlines then were people started saving their money. They couldn't travel. They couldn't go places. A lot of folks, and you're seeing this, we also are looking at 2 different data points here. The top 20% of households by income in the blue line and the bottom 80% in the red line. And you see an increase in both places, but you really see it in that top 20%, right? So these are folks who have more discretionary income to spend. And they certainly had an excess of that early in the pandemic, and now that is part of what has been driving that spending boom over the last several years as vacations picked back up, people could get back out into the world and buy plane tickets, hotel rooms, et cetera. What you see, though, on the far right-hand side of that table is that now today, we're to a point where a lot of that money has been spent. So now there's a little bit of a gap between what we projected people would have in terms of wealth and what they actually have. So when we show that gap, it's showing you that the top 20% of US households have 2% less than we thought they might have pre-pandemic. And the bottom 80% of households by income have 13% less wealth than we thought they might have. That's meaningful if you look at the right-hand side of this page, where we look at credit card delinquencies. And where this comes into play, and let me just give you the backdrop of, I looked up what the current average credit card interest rate is today. Depending on your source, it ranges between 24 and 28%. So that's what your average consumer is paying on credit card debt. So it's probably not a huge surprise to see that credit card delinquency rates, which is that right-hand scale on both charts, have spiked, both for the bottom households by income, which is that center chart, up to over 2.5% delinquencies. And on the right-hand side, for those higher earning households, have spiked up to almost 1.5%. So this is meaningful if you think about where people can keep borrowing from or spending from to keep the economy moving. Other sources of spending are things like, for homeowners, HELOCs, or access to the wealth that they've built up, because home prices have certainly risen over that time period. But again, interest rates have risen. So if you're looking for an additional source of capital to do that home remodel, you're paying a lot more on that today as well. So to me, and to I think all of us, these are all things that are maybe not a red flag, but certainly a yellow flag in terms of what's facing the consumer and what might we see going forward. Another risk in the markets, and kind of looking at things from a different perspective, where have all those great returns come from? Stephanie highlighted that the Magnificent Seven have certainly driven US equity market returns. We've all heard about and talked about those over the last couple of years. This slide tries to put it into context in terms of, and we say the Magnificent Seven, but really it's somewhat easier to just think about the 10 largest stocks that are driving US stock markets over the last several years. So if you think about looking back to 2018 and where we sit today, the influence of those names has dramatically increased. And you can sort of see that on the table on the right, where we look at the contribution of the returns from the top 10 in green relative to the overall annual return of the Russell 3000, which is the blue. The remaining 2,990 stocks is in blue, and the top 10 are in green. Now, we have been here before in terms of seeing concentration in the stock market, right? We saw it with blue chip stocks. We saw it with Japanese financials. We saw it at the beginnings of the internet with stocks in that sector. What's interesting today is not so much that there's a concentration in, say, the S&P 500 or the Russell 1000 in those top 10 names. The real difference is how much they're driving the overall returns of the stock market. So it's not just that they comprise a huge percentage, it's also that their returns have been so extreme, in a good way for the most part over the last several years, that they have carried a lot of that stock market return with them. So what does this mean when you think about the CalSTRS portfolio? One, it highlights, I think for all of us, the importance of having a diversified set of stocks within your portfolio. So you have exposure to broad passive markets, which means you have exposure to all of those largest top 10 names, plus those other 2,990, which may have their moment in the sun at some future point that none of us can predict accurately. You also have exposure to fixed income, risk mitigating strategies, other asset classes that, if and when we see a decline in some of those big seven names that could push the stock market in the other direction, you should have some ballast in your portfolio to participate in other drivers of return. I think that that's important because it's really difficult to predict what the next risk might look like, when it will come, and how it will come. And having a portfolio that is diversified cannot be overstated as an important factor in the success of CalSTRS pension results over the long term.
Great. So the final big risk we're going to highlight is political risk. There's an election coming up, so timely to highlight this. And I'll note in the context of the big risk we're highlighting here, there's almost a limitless list of risks that we could be highlighting. We highlighted what we thought were kind of 3 most interesting and timely ones for you. But what's good to always bear in mind with respect to risk in the markets is that, particularly in the public markets, stocks and bonds, the markets typically do a pretty good job of discounting the odds of risks affecting the market, at least the risks that the markets know about. The risks that tend to really move markets a lot are the risks that are surprises, the risks we don't know about. Those are the really hard ones. So in terms of political risk, this is a risk we know about and the risk the markets know about. And the markets have already started discounting the odds of different types of risks and opportunities from the U.S. election that's going to be happening in several weeks. 2 types of risk broadly under the term political risk that we would highlight. One are policy risks. Different administrations have different policies that they advocate for. Some of those policies become law or become in effect. Some of them won't. The market will place odds on all of that. And some of them are disruption risks, the kind of follow-on effects that political change can have on the underlying economy. And I'll highlight just a few of these policy and disruption risks here. The first thing I would highlight is many of the economic policies of both parties from an economic standpoint point in a similar direction, but with different priorities and different scales. Both parties are advocating for tariffs, for example. The Harris campaign is advocating for continuation of tariff policy under Biden, and the Trump campaign is advocating for an expanded use of tariffs in the economy. Both campaigns are supporting tax cuts, different flavors and colors of tax cuts, but tax cuts nonetheless. And both parties generally are supporting what economists call industrial policy, a policy across the spectrum that supports industrial production in the U.S. versus outsourcing outside the U.S. The interesting thing about all of that is it tends to point towards more deficits and higher U.S. debt. And so one of the likely risks that the markets will be absorbing through the election period is how well the U.S. bond market can absorb higher levels of deficits and debt without increasing interest rates, which again would put additional stress on consumers, as Mika went through. I also want to highlight that tariffs as an economic policy tend to be inflationary. So we've been through a period now where the Federal Reserve has increased interest rates in an effort to reduce inflation. Depending on which economist you speak with, inflation is either mostly or entirely down to its longer-term target levels. But tariffs will make it more challenging for the Federal Reserve to maintain inflation in the future, and generally would point towards higher levels of interest rates in an effort to maintain inflation at Fed target levels. So the commonality in policy tends to point towards higher debt loads, higher deficits, and potentially somewhat higher interest rates than would normally exist absent these policies. On the disruption element, political and geopolitical risk generally focuses on the risk of war, which we have several hotspots and wars going on across the globe today, and related supply chain challenges to the economy. While our economy and many economies have become more domestically focused in the last 5 or 6 years, the economy is still a global economy. And supply chain disruptions, as we saw over COVID, do create inflationary pressures on the economy. So we highlight those as kind of the significant risks that Makita is focusing on currently, and we know your staff is as well. All these risks are known to us and to your staff, and therefore, by definition, your portfolio is structured in a way to help mitigate these risks over time through diversification across asset classes and diversification within asset classes. That concludes our report. We're happy to take any questions.
Thank you, Mika, Stephanie, Stephen, for your thorough report and insights. Reminder, the committee will also be meeting with Makita in closed session, and we'll have opportune time to speak with them about some issues that are appropriate for closed session. But we have some questions now. Ms. Gallegos and then Ms. Hendricks.
So you mentioned that our portfolio is structured to be able to withstand some of these risks, but some of the ones that you mentioned, like the increased deficit, the increase in debt, even the geopolitical risks, it seems that probability for these things have increased. So do you feel that we are adequately structured for the increase in probability that some of these things are going to happen?
The our comments around the portfolio being adequately structured to withstand these risks is not meant to imply that you wouldn't be impacted by these risks. It is meant to imply that CalSTRS has a long-term strategic asset allocation policy that, when developed, anticipates these types of risks in the marketplace. And that asset allocation process estimates risks that can affect different asset classes and risks that can affect the total portfolio in the combination of asset classes that comprise your total investment portfolio. So from our perspective, you and all investors would be impacted by these risks, but all of these risks have been appropriately reviewed in the context of your long-term asset allocation plan, and the allocation has been developed acknowledging these and many more types of risks that can express themselves in the marketplace.
Yeah, I'll just make a comment on the back of Steve's that it's not only the asset allocation, but your board and staff have worked progressively on being able to create a systematic process to be dynamic. And so there's the event, and hopefully your asset allocation is diversified enough to help you withstand the first wave. But then we've been building flexibility around our leverage and liquidity tools to be able to have the type of liquidity. So if there is a market crash or crisis, God forbid, that we have the ability to also invest through that. And Deborah, as well as everyone else here, that's when you tend to see the biggest discounts. And you'll know when you see it, right? Because every crisis is different. We can't go in predicting what asset class is going to fall more than another one. But we've worked progressively on that. We have a leverage policy. We widened the asset class bands. We've created the total fund division, which I'll talk more about, and June will as well. So all these things, I think we've worked on the second leg of this to give us, more ability to be systematically dynamic when we need to.
Sharon?
So to build on that question, my question was, aside from asset allocation, how are we managing the risk? So what I'm hearing you and Scott say is, besides diversification, it's leverage, liquidity, widening our asset class band. Could you just kind of talk a little more, besides the diversification, how are we managing the risk, or give us insight into? So I'd love to hear from Steve and Scott, or Scott and Steve, or do you want to do that in? just give us a sense of, how are we managing the risk besides diversification?
Just a quick comment from a process perspective. In some ways, risk management is a culture, and CalSTRS has done a nice job over time of creating processes and procedures to stay on top of risks in the marketplace and to be able to adapt and change in the face of those risks when it makes sense to do so. Scott, I'm sure we'll talk about the RAC committee and different groups that meet regularly to review these types of risks in the marketplace. And that's an important part of risk management, both because the staff is enabled to act on risks that are elevated, but they also, from more of a cultural standpoint, they highlight for CalSTRS investment staff the value in staying on top of risks in the marketplace.
Yeah, and maybe I'll speak to three elements. One is our RAC committee. Two is the flexibility that we've been designing into the program, and I'll point to 2021 during the pandemic. And then a little bit more about asset allocation, because that's an ongoing exercise, even though we do it every 4 years formally. So just speaking about RAC, we meet as needed. So whenever the market is turbulent, we call a RAC meeting. And generally speaking, we can position the portfolio dynamically around where the markets are shifting, particularly in the public market assets. And so all the directors are invited. The members are our public markets directors, as well as the senior management team. So that's one element, and we meet formally twice a month, but as needed. The second, I just want to speak into, again, this idea around how we've been building flexibility around our liquidity tools so that we can be more dynamic in the market. And we need to look no further than in the past 5 years when we had the global pandemic, right? At that point in time, the first wave, having diversification, we diversified into the private markets as well as alternative assets. They did better than the public markets, which were both down, public equities and fixed income down double digits. The private markets were down less so, and RMS actually was up double digits. So we ended up being down 1.3% in a year. Stocks and bonds were down double digits. And so that diversification did pay off. Kudos to the board and staff for the strategic asset allocation in that year. The second thing we did was we managed the risk of the global equity markets being down at some points more than 30%, right? And that risk is that we have risk if our strategic asset allocation is moving so far out of band that we can't, adhere to that, right? That's a risk. It's a big risk. And so the markets would have moved global equities probably 10% wider than our strategic asset allocation. And at that point, June and team, as well as the senior team, decided to rebalance back mainly with futures and derivatives, which is a form of leverage. And we manage that risk. Now, it's a nice story because the next 2 years, global equities drove performance. And so it was a critical moment to manage risk at that point in time. So that's what I'm speaking to about using liquidity tools. The final thing I would say is a little bit about asset allocation. It's obviously an ongoing process. We don't stay static, right? And so in this marketplace, while growth assets have very high valuations, we have been finding merit in putting more of our allocation into private credit. We're still at a very low allocation as a fund, 2.6%, but it's been a good time across our asset classes to deploy capital there. We've moved more into fixed income. I've been writing to the board close to over $10 billion over the last several years, so we're moving into that. The energy transition, another interesting opportunity for us. We're finding opportunities there as well. And so we have that asset allocation, but with marginal dollars that we have in our cash flows, we're directing them to better and better opportunities as we move through a cycle. So those are just three elements to mention.
Any other committee members with questions? Before we transition to the real estate, to Taylor and Ben, from Makita's perspective and the staff's perspective, the current asset allocation, the bands that we increased in the last couple of years, you feel that's adequate for what you're trying to do in terms of managing the portfolio through potential volatile times?
Yes, we definitely feel it's adequate.
Great.
And we appreciate the flexibility.
Terrific. Thank you very much. Appreciate it, Steve. Thanks, Stephanie. Thanks, Mika. Taylor and Ben? Thanks, Steve. Morning, guys. Taylor, Ben.
Morning.
Morning.
Great. Ben Maslin, RCLCO Fund Advisors. We'll be going through some of the highlights of our open session report and starting with performance. So over the last 2 years, since the Fed had started raising interest rates, we've been in a period of valuation declines in the real estate space. So on average, indices are down about 17 or 18% over 2 years in values. And that in turn has led to negative returns over the past year and impacted performance over the longer term. Your real estate portfolio, however, has meaningfully outperformed its benchmark, which is the Odyssey Index, a collection of open-ended, diversified core funds investing in the real estate space. And over the last 10 years, that has led to 220 basis points of outperformance versus the benchmark. When you exclude the legacy portfolio, which is comprised of investments made before the great financial crisis, which still seem to have an impact over longer-term returns, that outperformance has increased to 310 basis points over the benchmark. And even over the last year, where there have been negative returns driven by those valuation declines, you've had 240 basis points of outperformance relative to the benchmark. The good news that Taylor will expand upon when he talks about the market is that we're likely at an inflection point in the real estate space, and that the period of valuation declines is most likely at an end, and we'll expect there to be valuation increases going forward, especially as the Fed has started to cut interest rates. So the combination of declining real estate values, along with, as Makita mentioned, a booming stock market over the last couple of years, has led to the allocation to the real estate portfolio declining. So the data shown here is as of the end of March. The report is as of Q1, and that shows an allocation of 13.9%. And as of August, the allocation is actually 13.5%, and compare that to a target allocation of 15%. So, that is still within the policy range, as Scott and Steve were talking about. There is a wide band of allowable ranges, but that is still below target, and that is something that staff is working on. I'll note all other policy restrictions are within compliance. And then, as in prior reports, we do always like to highlight the asset allocation by property type, because that does have a meaningful impact on returns. And you'll notice here that it shows an overallocation to office properties, but when you strip out life science properties, and we've noted this in prior reports, your allocation to office properties exactly matches the benchmark. So you are not overweight to office properties. What you are underweight to is industrial properties, and that is something that staff is working on in terms of increasing commitments to that property type, which has been one of the outperformers. And with that, I'll turn it over to Taylor.
And we'll discuss the allocation further in closed session, most likely. Again, Taylor Mammon from RCLCO Fund Advisors, thank you and good morning. To comment on the market, I think it's once again essential to break it into property markets, which is again the market for space, housing units and so on, and capital markets, which is the market for debt and equity essentially. Property markets, as we've commented before, have generally held fairly steady over the last couple of years since the Federal Reserve and other central banks started their rate hiking cycles in order to target asset values essentially. Couple of exceptions to that. Office, of course, which we don't need to discuss further unless you'd like to, is going through secular changes and has dramatically impacted office performance. Multifamily as well has held very steady for a long period of time. It's interesting to be at a time when we face long-term severe housing shortages throughout the United States, but in some markets, particularly in the Sun Belt, where there's been a lot of housing construction, we see near-term housing oversupply in certain property types, particularly new multifamily. And that has led to some deterioration, I'd say modest deterioration in fundamentals, which we expect to be fairly short-lived. But again, otherwise, property markets have remained fairly healthy over the past few years. In the capital markets, however, we've been through a recession, as difficult as many prior recessions, as property values have declined meaningfully as a result of the Fed targeting interest rates, raising interest rates to target asset values essentially and slow down the economy. That has had cyclical impacts on transaction values, or transaction volume as values have been uncertain, and so on. So where we are today is we think what Ben described as an inflection point, as we see inflation coming under control, as we see the Fed and other central banks beginning a rate lowering cycle. We're starting to see improvement in asset values, which provides greater liquidity, greater transparency, and hopefully the general recovery of asset values and a better performing transaction market in real estate as well. As Makita was mentioning, there certainly are risks to this. As we process the risks, there continue to be capital markets risks. The Fed could be wrong, of course. There could be remaining inflationary pressures in the market, and that could lead to additional tightening or additional financial industry challenges. We may experience a recession, which would negatively impact demand, which can impact market fundamentals more than we're anticipating. And then there are long-term challenges like environmental risk and regulatory risk as well. And so we're constantly tracking, and staff is constantly tracking these risks. But our base case is essentially that we're experiencing an inflection point, that the meaningful declines in asset values should start to turn around within the next few quarters, and coupled with continued steady market fundamentals should indicate a good trajectory for real estate performance going forward. With that, we'll pause and answer any questions.
Thank you, Ben. Thank you, Taylor. Ms. Gallegos.
My question is more broad and long-term. Have we changed the way we approach the asset class? It's such a space that it's not very nimble and it's like the Titanic, hard to move, especially if we see problems coming or experience difficulty in the market. Pandemic is one example. When we were shifting away from office prior to the pandemic, and then pandemic just sort of caused that to speed up. So how have we changed the way we invest in the sector, either the types of properties we invest in or whatever, to be able to be more nimble in the space?
Julie came up, so we'll defer to you initially, Julie. And comments,
Thank you.
of course.
Good morning, Julie Donegan, Director of Real Estate. A very insightful question, and we have begun to pivot within the specific property types of the portfolio. The data showed earlier declining traditional office exposure, which is something we started several years ago. We also leaned into life science, where we saw a pivot in that market as well. But coming out of the pandemic, we are focused on property types that are benefiting from a change. So if we think about industrial properties, those benefited from e-commerce, last mile distribution. So we are actively looking to increase our weighting to industrial assets. We've talked about multifamily and residential need across the entirety of the US. So we also are leaning in on various segments of residential, whether that's build to suit, single family for rent, traditional market rate, affordable housing. By increasing the total supply, we will begin to see rental rates coming back down. So those two have been clear winners, meaning industrial and multifamily, and we've already begun the repositioning and rebalancing within the portfolio. And then, I'd be remiss if I didn't mention retail. While we are focused on doing a lot of shopping online, there continues to be demand for necessity-based. Think about getting your hair cut or going to a gym, something that you physically participate in. That retail has been in demand. And this committee may recall that retail went through its lumps over the last 10 years, not too dissimilar to what office is experiencing, and it's now come back out the other side. So some glimmer of hope there for retail, but mostly necessity-based, and we've already started that rebalancing.
I'll just add a couple things. So one is that is structure. So historically, when we talked about the legacy portfolio, that was comprised of closed-end commingled funds where there's zero liquidity. You cannot sell anything. The vast majority of your real estate portfolio is invested through what are described as collaborative models, oftentimes in this room, and those are joint ventures and separate accounts, and actually investments in real estate companies themselves, and that promotes liquidity. So you actually have had in an illiquid market more sales than many of your peers, especially in traditional office properties, because of that structure. And then the other thing is strategy, where, as Julie mentioned, the several property types which have favorable long-term demand drivers, and there's an emphasis that we've actually tried to push to get to a top-down strategy to invest in those types of properties.
Thank you. Julie.
Any other questions? Okay. Thanks for coming up and participating, Julie. Appreciate it. Thank you, Taylor.
Thank you.
Thank you, Ben. Next semi-annual report, private equity, Tad and John, welcome.
Thank you. Good morning. John Haggerty, Makita Investment Group. I'm here with Tad Ferguson. We'll go through the highlights of the semi-annual report. As a reminder, this is a 6-month snapshot ended the first quarter of this year. And I'll just give you the overall assessment, which is quite positive. The private equity program is performing well, staff is executing well, it's in compliance with policy, and also the markets are functioning fairly well. We've talked historically about a slowdown in the markets, and we're seeing some abatement of that slowdown. A little bit of private equity context before I go through the slides. You allocate roughly 15.5% to private equity, but it is 25% of your risk budget. So you can endure a fair amount of volatility in seeking a fair amount of return from that portfolio. At the end of this period of time, you were at 15.5%. There was some concern prior meetings about getting to the upper bounds of the target ranges, but you're very close to that, 1.5% over your target. The risks, we'll talk a little bit about the risks if you seek them. I would generally say that we're talking about risks that are very similar to what Steve McCourt articulated for the global equity markets in this realm. However, you do see a little bit more sensitivity to interest rates, as a lot of the transaction activity is driven by the availability and the expensiveness or cheapness of debt to do these transactions. The private equity market, another allusion to the general consultant report. You should know that when we go through these performance figures, that there's a very significant lag on the upside for private market assets, and you're going to see trailing returns relative to the stock benchmark. But that's not of any concern to us. And then in periods when the stock market goes down, that's when the private market assets show their value. So I'll turn to the first slide. And note the slowing private equity fundraising market. Relative to the prior quarter, fundraising activity was down a full 10 percentage points, and that's understandable given that a lot of these funds are having some difficulty in providing distributions back to their limited partners. So a fairly challenging period of time for general partners and limited partners. That's related to the exit volumes, which have gone down. There are almost 11,000 funds raising right now. So it's quite a bit of competition for your capital and the capital that your team is looking to deploy. Prices are about the same. So the prior period we spoke about a 13.0 times EBITDA per purchase multiple on average. It's about the same at this point in time too. The returns have improved just a little bit, and so, but on the relative basis, as you'll see, compared to the global stock market, fairly big lag, which is not of concern to us. Okay, thank you. Here you see that performance is exceeding all the critical benchmarks, all periods longer than 1 year, the 3-year, the 5-year, the 10-year, fairly significant outperformance. The underperformance comes again relative to what we call the custom benchmark, which is the All Country World Index. Notably, that's the same benchmark that's used for your global equity portfolio. So the intention at the asset allocation level for this part of your portfolio is to provide a premium return for sacrificing liquidity of a full 1.5 percentage points per year to pay you back for the illiquidity in this portfolio. And it has done that historically, and for the 3, 5, and 10-year period for sure. This is the broadest statement that we can make. Again, I'll make reference just for simplicity to the same benchmark again that you use for a global equity portfolio, and then adding another 150 basis points to that to get to the illiquidity premium and the true benchmark for the long-term benchmark for the private equity portfolio. We've provided this in the past. The bottom line is that if you had taken the same dollars that went into this private equity portfolio since 1988 and put them instead into the MSCI equity index, you would have gotten significantly less, or $50 billion less. So we showed 2 figures there, the ratios. The way to think about the ratio, the 1.31 ratio, is that you get 31 extra cents for every dollar you put in to the private equity portfolio relative to the MSCI equity index without the premium added to that, and you get almost $1.25 versus $1 for every dollar that you put in to this theoretical index that added 150 basis points per year in return. So really been a big winner with respect to its asset allocation goals over time. Okay, and lastly, I'll just note that as we've noted in the past, buyouts are the real driver of the portfolio. They're a good 2/3 of the, or 3/4 of the portfolio. And for all periods going back to inception, they've added value relative to the State Street Global Index. With that, I'll turn it over to Tad.
So good morning, Tad Ferguson. On this next slide, we dive a little bit more into the relative performance between the fund investments within the private equity program and the co-investment activity. And as a reminder, the co-investment program is the primary method of implementing the collaborative model within the private equity asset class. And there's been a concerted effort to increase that exposure over the past several years, which now represents 22% of the private equity portfolio. And put that in a little bit of context, 5 years ago, the co-investment represented only 5% of the total program. So there has been significant growth within the co-investment programs over the past 5 years, and there's, as demonstrated in the outperformance relative to the funds over the 1, 3, 5, and 10-year periods, successful implementation of that program. And along with this kind of dedicated, consistent growth over the past 5 years, while transaction selection is a key component within that, overall diversification and portfolio considerations such as industry exposures, transaction sizes, are part of the overall construct that staff is considering when they're implementing their co-investment program, but it's contributing to that outperformance relative to the underlying funds. On the next slide, a little bit more comparison across geographic exposures. The program is categorized in 2 large geographic classifications, North America versus non-North America. Across the 1, 3, 5-year periods, very strong relative results relative to their benchmarks. The one-year numbers, a little bit lower absolute returns. As John mentioned, there's been a little bit of compression in the returns over recent periods. But North America is the largest exposure within the program. It's approximately 76%, so that is, driving overall results. And over the longer periods, while there's slight underperformance relative to the benchmark, there's very strong absolute results within that geographic classifications. On the non-North America, while that's been strong both relative and absolute across returns across time periods, the underlying exposures is primarily Europe, but there is significant rest of world and overall additional geographies. So overall appropriate geographic diversification that's contributing to overall portfolio results. Implementation, kind of capital deployment across vintage years and across economic cycles are both a very key component in the construction of a private equity portfolio to reach and maintain the target allocation, but also deploying capital across economic cycles, key diversification benefit. And this chart is highlighting the underlying vintage years of the general partners, which is defined by the first capital call. And that definition results in a little bit more annual variability than you might see in actual capital commitment deployment by staff. There's actually a very disciplined and consistent underlying pacing that is, the approval process of commitments to funds and co-investments, where, a similar trend of higher, in the 2020, 21 levels, but not the volatility you see here. Kind of over more recent years, there has been a reduction in that overall pacing just to reflect that the program is at or slightly above the target allocation, and that, as John mentioned, there's less distributions coming out of programs, so there's more market value in the program. So that's contributed to a higher allocation, and so overall pacing has been slowed down the past couple of years as there's been a very disciplined process. And even within that, the blend between funds and co-investments is very thoughtful in the proportion as they have different timing of cash flows and deployment. So overall, consistent underlying commitment to capital on an investment decision basis. In the last section, just the portfolio is diversified across 6 key strategies. As John mentioned, buyouts is the largest. It currently is about 77% of the total portfolio, and given the strong results in that sector strategy, it's been a very strong contributor to results. But overall, across all 6, very close to target and within target range, so in compliance with the key parameters in strategy diversification. And with that, I will pass it back to John.
Yeah, so I'll wrap up and reiterate that the program's performing well, the staff is executing well, program's in compliance with its policies, and the market's functioning fairly well too. The pacing, which Tad had just spoken about, I want to underscore that there was a run rate of roughly $7 billion of deployment, which you saw in the prior chart in the years 2018 to 2020. That's been adapted to address the current market with a slowdown in distributions. 2023, that figure was about $3.5 billion, and we were at, as of creating this exhibit, 3.7 for the current calendar year. And looks like 2024, it looks like this year will see something on the order of 4.5 in commitments from the private equity program. So being reactive, my point is being reactive to what we're seeing with the slowdown distributions and making sure that the private equity proportion of the total fund is close to the target. We show on this page 15.8%. It's closer to about 15.4%. And that's a result of the very, very strong stock market performance. As of just last night, year to date, the stock market's up 21%, depending on which measure you use. And so when we look forward to the next semi-annual report, we're going to be saying, you can bet we'll be saying the same thing, that a very strong stock market performance has left private markets behind just a bit. With that, I'll wrap it up and see questions.
Thanks, John. Thank you, Tad. Questions from the committee? Can't let you go without a couple of questions. The growth of the co-investment program, as the team continues to scale and execute, any risks that they're trying to monitor, or how you're interacting with staff in terms of mitigating any additional risk as the program grows?
The co-investment program is a topic of conversation each time we speak with your staff. The program as a percent of deployment continues to grow. I believe it went from 21 to 22% of your in this reporting period. So one concern is always deal flow, and so far we're not seeing any issues with getting the deal flow to make sure that the deployment's roughly a fifth of what you put out relative to funds. The main risk, and we'll talk about this when the policy item comes up, is just the idiosyncratic risk of any individual company that you make an investment with. And so we make judgment calls with policy about limiting how much you can put into an individual company. The other factor, I suppose, is the staffing that's required for this. This is indeed a transaction. Co-investments are different fundamentally from fund work, where you're mostly talking about a blind pool, a promise about what the manager will buy. And in this case, you need people on staff that can analyze an individual company and make an assessment of its valuation. So one of the things that we talk about is just staffing and making sure you have people with those specific skill sets that are on your team, and enough of them to do the work.
So if we're putting out $4 billion, pacing for $4 billion, 20% of that will be approximately in co-investments.
It will depend on the time frame. In fact, this year the proportion's a little higher for the co-investment deployment relative to funds.
A broader question, more industry-wide. Clearly, one of the points that keeps coming up in your reports year after year is the importance of manager selection. You've also indicated the last couple of years that there's over 10,000 funds out there. So as these firms have grown and expanded and developed and evolved, any concerns that you or the staff have as these larger firms that we've relied on for so long, these important relationships, as they grow and evolve, how do we ensure that we still have the level of confidence that they can continue to produce the way they have as they grow? Just in a general way, how do you think about it?
It's an essential question. There's many parts. I'll try to be as brief as I can. There's a lot there. First is alignment. The larger a fund gets, the more a set of partners can become quite wealthy, frankly, from just the management fee alone, rather than the traditional model where the carry was what everyone was playing for to provide the incentive. So alignment erodes in many cases, not always, but in many cases with the growth of funds. The other thing that we're watching out for is the proliferation of strategies. We're only concerned with private equity, and we'd in some ways rather not have a manager that is distracted potentially with running a real estate strategy and a debt strategy and a smaller market strategy. So that's something to bear in mind, and it's a challenge as you continue to look at your partners in private equity. Is the CEO and the leadership of that focused on what you care about, which is your asset class? So there are a number of things. The other, it speaks to the broader asset class consideration. I spoke of a 150 basis point so-called illiquidity premium that you're expecting out of this asset class. I think it's reasonable. We certainly will let you know when we lose faith in that, and that would flow through asset allocation work. We think that's achievable, but with each dollar that goes into a market, it becomes more efficient, becomes more competitive. And so the playbook that some of the large brand names that you can conjure up in your head right now used to make a return on a buying a business and selling it to someone else in the future for a higher price, that playbook is better known, and it's a little bit less of a distinguishing factor for a number of the private equity players than it was 10 years ago, 15 years ago. So just the competitiveness and the ability to have an enduring advantage in the market is something we need to look at too.
And I just quickly add, in discussions with staff, talking about, there's a limited amount of slots in the portfolio that they're looking to do. So each kind of spot or seat is highly competitive, and so it's an ongoing compare and contrast about the portfolio lineup. And given the lower pacing over the past couple of years, there's been descriptions of some hard decisions being made, not just participating with the same managers, but being a much more highly selective given this environment.
Yeah, I'd like to underscore that. There's two ways to approach going from $7 billion deployment down to half of that. One would be to cut down the allocation to every single manager, and another would be to make hard decisions. And I think your staff has made the hard decisions.
Just final question, back of the envelope, how much capital are, say, the 5 largest private equity funds sitting on currently, approximately, cash?
In your portfolio?
No, in overall in there, that they can put to work.
Oh, it's got to be I'm just quick math, $100 billion. It's something like that.
15 to 20 billion.
Yeah.
All right, thank you, guys. Yeah. Thank you, Tad. Thanks, John. Why don't we take a 10-minute break, and we'll come back at noon with our CIO report. Okay, we'll come back at noon.
Well, this is the inaugural on-camera CIO report. No pressure. I'm going to talk about, I'm really going to talk about 2 things. One is our people, and the second is performance and risk. And so it's been no surprise, I've shared this with the investment committee, exec staff, my own staff, that one of my biggest priorities this year is focusing on the people. We're in the middle of a transition, passing the baton from one generation to the next. And so for me, I remind myself all the time, focus on the people as well as the billions, because for me, in a leadership position, it's really all about leading through people. And so overseeing this evolution of leadership is my highest priority, and it's definitely one of my top 4 for the years I shared. I want to talk today about 2 retirements and 5 promotions. I emailed some of this to the board or investment committee in detail in emails, but I want to start with the retirements. Now, Glenn, that turkey is in Las Vegas, living his best life, but he escaped through the back door. He never wants to be recognized. That's why I call him a turkey. But we have Glenn retiring, longtime head of our fixed income division, and Paul Shantic, head of our inflation-sensitive division. So Paul's not a turkey. Proving he's not a turkey. For both Glenn and Paul, I'm going to miss them. I've worked with them, have a lot of respect for these 2 gentlemen. They were great folks, gave me a lot of advice, feedback that I needed, never shy of giving me the truth. Constructive feedback, which I needed as a deputy, needed more as a CIO. And they're great team members, just fantastic team members. And for me, I'm going to miss their steady hand, their wisdom, because they're both, as you know, great experienced folks. So for Glenn Hosokawa, who said he would tune in from Las Vegas eventually, 25 years at CalSTRS. When you look at Glenn's performance, you almost take a double take. I remember when I started here thinking, wow, is this fake? It's so consistently good over time, Glenn and his team. And I think what was unique about Glenn and the team is that they're our true sort of internal money manager, taking active risk and performing. That's something that, they were the original collaborative model implementers along with global equity. And that's an important skill for us to continue. So kudos to Glenn and his team for that. I'm not only going to miss Glenn for his advice, but I'm going to miss Glenn because I could always call him in a town hall, in a meeting, and he had a quick wit. He would always come back with something funny, lighten the mood. And even today I was telling him about honoring him, and he said, well, reserve a spot, if I gamble away all my retirement savings, in Las Vegas. He wanted a spot as an IO working underneath Rosie. So I thought, this guy's just, he's hilarious. So let me talk a little bit about Paul. 31 years at CalSTRS, 31 years. While Glenn was known for his consistent alpha, Paul was known for the size of the alpha. 2.3% alpha over each year of the last 5 years. Very significant. He won our prestigious internal alpha award. You had the bragging rights amongst all the asset classes. I believe that was in 2019. If not, he could have won it a second time. Paul's team is unique as well as Glenn's, just in the sense that we were growing this asset class. At the same time, he was called upon to outperform, right? So he started maybe at 2% or so asset allocation when I started here, going up to 6% and beyond. And Paul has been one of my cornerstone directors. He is contrarian. So we're always looking at Paul for inflection points in the market. We're like, Paul, what do you think? Yeah, is this an inflection point? One or the other. But as Glenn had a quick wit, Paul had a dry wit. And so we thought, who better to roast Chris Ailman, during his retirement, and Paul did probably arguably the best job. Both Paul and Glenn, I think, made an incredible impact for our over 1 million California teachers. I want to congratulate both of them. I'm going to miss them. I could say I'm sad to see them go, but I'm also happy that they're beginning this new chapter of their life. And with my deepest gratitude and the team's for your 31 years of service, Paul, and the 26 years for Glenn Osakawa. Now, we joked that this is the splash zone for the staff because just like in SeaWorld, the investment staff doesn't want to be recognized in the splash zone. So we kind of had to pull their teeth. I did want to pause here for a moment. I've told this to many of you. It's a poignant moment for me because I'm in the middle of this generation, one that is retiring, an older generation, and complete excitement for a new generation. And to me, it's really, truly a passing of the baton, a passing of the torch. That doesn't happen overnight. It was very intentional that we do this. I've told many of you, culture to me, for the investment team, is one of our biggest competitive advantages. How we operate as a team, how we're motivated, engaged for one purpose, one mission for the teachers. And so it doesn't happen overnight, right? And so how do you ensure the continuity of this culture, the continuity of our investment processes, the continuity of our teamwork, and hopefully, in my mind, then the continuity of our strong performance? Well, it's through this mentorship, right? So, as I get to the rest of the splash zone, June, I want to thank for coaching and mentoring David, Glenn for coaching and mentoring Rosie. We had Paul helping to coach and mentor Charles. I have my senior directors, Mike and Geraldine, overseeing these transitions, making the selection, hiring, and also doing their own coaching and for these asset class directors. So I think I just wanted to pause here and capture that moment. But now maybe on to the fun and exciting stuff. Let me just get to the promotions. First off, June Kim, promoted to Senior Investment Director of the Total Fund Management Division. This is a new division formed out of our investment strategy and risk division. It's to, number one, create alpha at the total fund level and help to facilitate that. And two, it's building, again, a more flexible and dynamic portfolio. There's a lot of reasons why June was selected out of this competitive search, but let me just rattle off the top four. Number one, it's overseeing CalSTRS' largest asset division, global equities. Number two, she was one of the key members of our RAC division, our RAC committee, and that has everything to do with us managing our liquidity, which is going to be crucial in this role. She significantly built out our internal management, and also she helped to shape CalSTRS' vision and strategy as the first and current Diversity and Equity Steering Committee Chair here. So again, I want June to stand up. Oh, she's looking at me now. Yeah, that's the splash zone. Get used to it, guys. That's right. Well, next up is David Murphy, who was recently appointed Director of Global Equity. David's not a newbie here. He joined CalSTRS in 2006, 18 years already. He most recently was the Senior PM of Global Equity in 2023. He's been really instrumental in managing both our internal and our external portfolios. And with 80% of our portfolios now internal, his experience in integrating that has really been key to the outperformance over the last decade. Yeah, and yes, I said outperformance in a very efficient asset class, global equity. So, David Murphy. You notice I have to keep asking them to stand up. They don't stand up automatically. Rosie Lucascini-Jack, recently appointed Director of Fixed Income. Rosie, not at all a newbie either, been in fixed income here for 23 years. She became a Senior PM, like David, in 2023. That was, of course, part of our succession planning. And before that was a PM for 10 years, and before that, Investment Officer for 11 years. She's really focused on, as you know here, because you've seen her in TAC, the U.S. rates portfolios, doing the macro trend analysis and currency management and tactical trading. In more recent years, she's helped to start to build out our direct lending portfolio on the private side, which we've housed in fixed income. So, Rosie. Next up is Charles Fitzpatrick, who's been appointed our interim Director of Inflation Sensitive. Charles joined CalSTRS in 2014, 10 years here, in other words, after 7 years at CalPERS. So yeah, sometimes we steal the better ones and bring them over here. He spent 8 years at the Treasurer's Office before that. Charles, along with Paul, they've really been he's been integral in growing the infrastructure portfolio. When he started, it was $1 billion. Today, it's $12 billion, just to give you an order of magnitude. And that infrastructure portfolio is about 2/3 of the total inflation-sensitive portfolio. So, Charles Fitzpatrick. And finally, Sally Stocks. She's not here, but she's our new senior PM of real estate. And Sally joined us 3 years ago, where she's really been a PM focused on overseeing our retail and mixed-use portfolio. She's also worked on the residential side as well as our real estate operating companies. Most of her career has been spent on the private side, so she's bringing that experience to diversify our own experience here. And one, I think, final note, which is really important, she's passionate on her mission, and she claims she's held accountable for the performance for her son and her daughter-in-law, both whom are CalSTRS beneficiaries. So Sally Stocks is not here, but I would definitely wanted to recognize her. So with that being said, again, for me, one of the biggest priorities this year, if not the largest, is to help oversee this leadership transition that we're undergoing. I'm really excited for our next generation here. I want to talk a little bit about the performance and risk. So most of you know this, but more than 60 cents of every dollar provided to a retired teacher comes from our investment returns. Fulfilling our mission and securing the retirement future of our teachers, that can quantitatively be expressed really in two goals of the investment division. One is to meet or exceed our 7%, and the second is to exceed our benchmarks and create alpha or value add. I'm not going to focus on the 1 year, and I'm going to focus on the 5 year because I think the consultants will be focused a lot more on the 1 year. But if you looked at our 5-year numbers, we generated 8.5% a year, so exceeding that 7% hurdle. And the biggest driver of this performance was our strategic asset allocation, right? So the board, every 4 years, sets the strategic asset allocation. And this is a moment where we can look back, how did we do? Well, over the past 5 or 6 years, the trend for us has been to move more of our public markets assets into the private market assets. And so staff, in implementing the strategic asset allocation, shifted or moved roughly $50 billion over this 5-year set into the private market assets and the alternative assets. And that's, a significant reason for the 8.5% performance. Diversification is the first investment belief. It's the foundation. So if I look over the past 5 years, that diversification really paid off year by year by year by year, because it's impossible for us to predict how these asset classes will perform within those years. And certainly there were surprises and bumps along the way, but our asset allocation over the long term is supposed to diversify our asset base across market crises. Of course, we talked about this already, but we experienced the pandemic in the 2021 fiscal year, where we were down significantly. And I would point there to the board's decision on the strategic asset allocation. That was a defining year, where the diversification really paid off. But also I want to point to the investment committee's decisions around our liquidity, our leverage policy recently, and widening the asset bands, because that was a year where, to manage risk, we had to rebalance back into global equities. And now in the future, we have a lot more flexibility and capability to do that. To the second point, we outperformed our benchmarks by the tune of 77 basis points per year over the 5-year period. So I think what you're seeing is a growing value add that the staff is producing above the benchmarks. And so that translates into, call it, greater than 10 billion of additional value towards our teachers and the trust. This steady increase in value, again, can be pointed back to the history of decisions that the staff and the board made together. One of the decisions we made was to accelerate the collaborative model and to build our investment experts across each of the asset classes. To me, that is one of the biggest reasons why we produced outperformance. On a cost basis, we have been below our peer sets. We saved roughly $1.6 billion in costs. The board is going to hear every November relative to our cost report. But on the other end, the staff and the experts within each of these areas have been adding greater and greater value above the benchmarks. And so, I wanted just to tie in the last 5 years with some of the decisions we made. The other thing we did, and this was identified in Makita's report, if you looked at our peer set, we have been operating at a below average risk level over the last 5 years. That's 8.8% volatility in the Makita's reports. And I think what you're seeing here is that staff has become more and more efficient in optimizing active management and active risk. And I would point to some of the decisions, again, between staff and board as we decided to move into risk budgets for our global equity and fixed income divisions, both June and Glenn helping to spearhead that. Oh, great, thank you. And so I want to talk a little bit about that. And the other decision, as we moved into accelerating the cloud model, we built a lot of the backbone behind the operational infrastructure, which the board and staff had a role in as well. So anyways, I wanted to look back and just make sure we understand how we did in terms of the decisions that we made together. The other element is, of course, nothing ever went perfectly to plan, and there are quite a few surprises. We'll talk more about this in the closed session. Real estate, for example, if we had a crystal ball when we decided on the asset allocation, we didn't see that we'd hit the pandemic, which would change the way the workforce was structured. We also didn't we knew there'd be some inflation, but the huge increase in interest rates and how that would affect a sector like that, the staff did outperform. That was certainly one of the unanticipated areas. And so there are always some unanticipated areas, but as a whole, I just want to look back and reflect that the diversified asset allocation and the role of staff in implementing that, to me, looks pretty solid, even despite some of the bumps along the road. So let me just clean up by talking a little bit about some of the risks of our portfolio before taking some questions. I want to point out some key elements in the CIO report. One of them is looking at page 3 of the CIO report. You can see that 76% of our risk or volatility is directed to our growth assets, both global equities and private equity. And so this came up in some of the conversations, but as we're pointed towards growth and with the potential of the economy slowing, or the fact that these growth assets are on the higher end of valuations, this could be a headwind for us. The second, I want to point you to page 5 of the CIO report. You look at our geographic dispersion, 81% were fairly domestically oriented or dollar denominated. Right, we talked a little bit about, Steve McCourt talked a little bit about the higher deficit levels. And so that could become an elevated risk, but it is somewhat mitigated by the fact that our liabilities are denominated in dollars. And of course, our staff is domiciled in the US, so we have an advantage in adding more value. This is something that I'm having June Kim take up in one of the risk reviews of the portfolio. So you'll be hearing more about that in the future. I wanted to just give you a heads up there. The second element is on page 17 and probably page 16. You can see that we have the ability to utilize leverage, but we are preserving liquidity, right? And so we have a net cash position at the end of July. It's shrunk a little bit, but you see us preserving cash both in how we're pacing in the private markets, but also how we're spending our liquidity. And this is intentional because we're waiting for potentially better opportunities, or if there's a recession or a market crisis, preserving that liquidity so that we can strike. What do we think of the current environment? I think it was mentioned already. Expect more volatility as you think about the market participants weighing in on the Fed and the economy, growth assets being fairly highly priced. In other words, all the moves that the Fed has been telegraphed has been priced in the market. The market believes there'll be a soft landing. There are a lot of rate cuts already priced into the future curves. So those are all, I think, key elements for us to consider as we think about the near term and the volatility. Anyways, I'll pause here. I know we covered a lot with the people and then the performance and the risk.
Thank you, Scott. Let's get to a couple of questions. Ms. Gallegos, followed by Ms. Hendricks.
Sure. Thank you, and congratulations to everyone who's been promoted. On the private equity distributions, how much of an impact is that having, or the lack thereof? And how far, what are the market dynamics there, and how much longer do you think that's going to be an impact? Was it primarily a result of the increase in interest rates? Were there other factors, the market environment not allowing managers to exit various deals? And how do you see that going forward, and what's the impact ultimately on the portfolio?
Yes, so just starting about 2.5 years ago, we started seeing a lot less exits. And for a small period there, we were net negative in terms of our cash flows between what we needed to contribute and what we were drawing back in terms of the exits. So this has been, every year we've been revisiting this question. To your question of when is the ice going to thaw and more deals come to the market, with a rapid rise in interest rates, I know we're now in an easing cycle, but if you could imagine an entrepreneur is stepping in the room and his company's valued at $10 billion, and then all of a sudden, with the rise in interest rates, his company, people are saying, is valued at $2 billion if he exits. Of course, there's some stickiness because they don't want to exit at that price. They're thinking, I can exit at that former price. And I'm just using an entrepreneur as an example, but going through all the rest of the areas of buyouts and other parts. And so when there's a little bit of a bid-ask spread dilemma here in terms of like what can you get in an exit versus what you think you want to get, right? So there is that. I do think that as the Fed begins to ease, and that's going to affect the short and the middle end of part of that curve, that it could lead to more sort of thawing, because that's a big lever. Of course, the market has already priced that in, and so as long as the Fed continues to go at the pace of the market, I would say that now we're going to most likely start to see the ice thaw more and more, not only in private equity, but also real estate and in other areas because of that alone. That being said, I do think there's a little bit of a tortoise versus the hare dilemma, where the Fed may go more slowly than the hare of the markets, because the markets, again, they've priced in a lot of rate cuts. And will that be trued up somewhere down the line? I know he came out with 50 basis points, so he met the market, but we'll see as we move along. So hopefully that gives you some answer. What we decided to do, Deborah, just to close the loop, is we decided to pace down with the market. I've always been asking Margot and Mike and the rest of the team, if you need liquidity and you see the opportunity in the market, we will provide liquidity for you to take advantage of it. But right now, they don't see this as a superior time to invest and to utilize our liquidity. So we have been pacing down with the market. And 2.5 years ago, I think that was big news here, we started to indicate transactions are down 60 to 80%, right? Well, they've pretty much stayed down for some time. Now, I know there's an army of investment bankers out there looking for deals, and so we'll see if they hit any.
Thank you.
Hendricks?
Yeah, thanks. So one of the things, I appreciated hearing your comments, Scott, about the focus on people. I think, we take a lot of pride in our culture around succession planning. I think sometimes members think it's funny that we talk about succession planning as soon as someone's hired. So I think like with Cassandra's, the transition with the CEO, the transition for Chris. I do want to give a shout out to Chris Ailman today. Maybe he's watching, I don't know. But just the thoughtful planning and, to me, the really measured process of the change that we're going through. I just really applaud you, Chris, Jack, Cassandra, all those that are part of that process, and really excited about the opportunity that folks have to advance in this organization. I think that's really important. If you're curious and want to learn new skills and contribute more, that there's an opportunity for you to do that here at CalSTRS instead of somewhere else. I'm really excited about hearing about that, and congratulations to all of you on your promotions. With that, one of the trends I've been looking at, and I just kind of looked over metrics, is just public companies and how the trend, I think in the 90s it was like 8,000 companies, and now we're at like 4,000 companies in the public markets. And then watching the trend on our asset allocation from over 50% in global equities to 38-ish%. Can you just talk a little bit about, a lot of people are seeing that trend. I know a lot of the reasons why that's happening, but as we think about that at CalSTRS and as the CIO, how do you, it's sort of a macro question, I guess, as that trend, I assume, will continue, and there's more regulations and things that maybe push people to stay in the private markets. We've talked over the years about the challenges of the private markets and the opacity and some of the, labor issues we hear about in the boardroom. How do you think about that, Scott, and sort of that trend happening? And then how do we, as an investment team, I guess, manage, adapt, influence, and think about what we need to do in the future to ensure that our entire portfolio has the same kind of rigor in our policies with our partners as we've always had in the public markets? So I wonder if you could comment on that.
Yeah, let me just say, broadly speaking, that you're seeing one of the biggest trends in citing that this movement towards the financing of the world's needs, both with the public markets and a growing segment being the private markets. I see both areas as being great ways to finance. There's pros and cons of public markets and private markets, so I'm not going to really get into that. But there are some unique aspects for us to manage and mitigate risk, as well as the selection processes around private markets, right? So on the upside of this, we've talked about the collaborative model and how we're going to execute that to help us take advantage of these opportunities better and better and better, right? It's also an area where we think we can control and mitigate the risk, because the more influence we have, if we own part of it or we're directly invested in it, we have more control. So that's an area that we've moved more and more into, and I think as this theme dominates, it really plays into that. The second element is, there are some unique areas of the private markets, and so one is transparency, right? There's less transparency in the private markets. The other is regulations, right? It's less regulated. And the third I would mention is alignment, right? So, because typically on the public side, we're directly owning an organization and we're exercising our proxy votes, et cetera. But on the private side, we're aligned with usually an external manager. So we are engaging those external managers to see through to how things are being done on the portfolio company side, right? So this is something that we're not new to, right? We have a very extensive set of policies, a very extensive set of processes that staff goes through. But I think given the maturation of the industry, as I think you're leading to, it's time for us to revisit that. And so we haven't yet spoken into this, but we have on the work plan project, the private markets in principles and engagement work plan. And so here you'll see us wanting to work with the board on the governance of this. Do we have the right investment beliefs that are foundational? What have we reviewed our policies? Are they modernized and streamlined for their current purpose? And thinking about how we then implement those principles as staff aligns the interests with those managers. And so more to come. I'm hoping that we bring this forward as an introduction in either the November, but most likely the January meeting. But I think those are some takeaways that we're going to review together as an organization.
Thank you, Scott. Seeing no one else in the queue, thank you for the report. Big thanks to Paul and Glenn for their service. And Glenn, the longer you stay in Vegas, the less likely you're going to be successful. So get home. Get home, buddy. We don't want to come get you. And congratulations to all those that have received and competed for promotions. I know we're in great hands. And, with the team concept, I have confidence we'll continue to do really well. And as all the change that we're going through the last couple of years here at CalSTRS, even here on the dais, the one constant is our mission. So let's just stay focused on the mission and purpose. We'll be okay. Thanks very much, Scott. Next item is we have a policy revision in private equity. And Margot, Rob Ross, and Georgia Pappas are going to come up. As they're getting settled here, Makita, John Haggerty, and Tad Ferguson have an accompanying memo in this item and highlighting their support for the proposed policy change. And I would highlight their final paragraph in bold print, which summarizes their support for this. So we'll hear from staff, and depending upon the discussion and level of questions, we may be in a position to adopt the change today. So let me turn it over to Margot.
Thank you, Harry.
Thank you,
Margot
Margot.
Worth, Director of Private Equity. I'm here with Rob Ross, Senior Portfolio Manager, and Georgia Pappas, who's a Portfolio Manager, co-lead of our co-investment program. So I'll just summarize what's in the written materials briefly. There's two elements of this policy change, and I have a couple bullet points on each. The first item is addressing leverage. And up till now, there is no mention of leverage in our policy. And this is kind of a result of the leverage discussion and policy approved in, I think it was January. And when we reviewed the individual sub-asset categories, all of the privates had a leverage policy except private equity. So we're rectifying that omission. The second thing I'd just like to say about it is it's principles-based. It's not very prescriptive. It's kind of hard to know exactly where we might want to use leverage in private equity. It will tend to be limited. So basically what the policy says is we are allowed to use leverage, but only in accordance with the use cases and limits set forth by the CIO. So we can't just on our own decide we think it'd be a good time to borrow money against private equity. The second element, it has to do with what's called the independent fiduciary for co-investments. And this is a policy that's been around a long time, over a couple decades, which says if we do a co-investment, we need to have a third party come in and also look at the transaction and agree that it's a good transaction for us. And so the issue there is that this does provide a level of risk control, but it also puts us at a competitive disadvantage in that the company we keep now, that the global marketplace where we're trying to compete to get into the best co-investment deals, this is off market. This is just not typically done. And so partners ask us, hey, do you want to come into the deal? And we say, yes, we do. And also we want to bring a third party with us. And they ask us, well, what the heck is this? And so what we would point out in terms of risk mitigation is that, in the 2 decades since we had that policy, when that policy was put in place, we had done, I'm guessing, 3 or 4 co-investments. We had no dedicated team. The whole team was probably 4 or 5 people on the investment side for private equity. Over the years, and especially over the last 5 or 6 years, when we focus on the collaborative model, we've built out a dedicated co-investment team. We have 2 portfolio managers in co-investments. We've gone from doing a handful of co-investments to, depending on how you count it, close to a couple hundred co-investments. And so we have a world-class team now. And I think Scott, during one of our calls, made the analogy of training wheels. It's perhaps time to take off the training wheels. That said, there is a provision that says this applies to deals under $250 million. Over $250 million, we would still use the independent fiduciary to provide extra safety. The only other factor I want to mention is if it's below 250, we still can choose to use an independent fiduciary if there's a circumstance that we think, hey, let's bring somebody else in to look at this. It might tend to be more specialized, but we certainly have nothing precluding us from doing that. And with that, Harry, that's basically the run through.
Thank you, Margot. There are questions from committee members. Assuming that Georgia and Rob, you weren't going to add anything to the initial presentation from Margot. Okay, great. Sharon?
Yeah.
And then Michael Gunning after Sharon.
Just want to make sure I'm clear then. Margot, I don't have concerns about the force issue. I think on the fiduciary council piece, my understanding is the rationale for us to make this change is around, we have more expertise in this space. So we understand it better, we have staff that understand it, and the other piece is nimbleness, right? So that we can make those deals with a little bit more efficiency and nimbleness while still, having fiduciary oversight if needed.
Sharon, I think you have it in, I phrase it as a competitive disadvantage. And, yeah, I mean, a third thing I didn't mention is, these are $40,000, $60,000 a pop too.
Right.
So.
Got it. So with that, it's our first reading, and I know there's other comments and questions from members, but I would suggest we could potentially move approval. I would be comfortable moving approval after this first reading.
Okay, so that's taking that as a motion. Is there a second?
I'll second.
Okay, it's been moved by Ms. Hendrick, seconded by Mr. Tang to approve this as take action on it today. But prior to that, there are other questions. Mr. Gunning.
Yes. Thank you, Mr. Chair. Marla, just one question, and it's really going what Sharon said on flexibility. Is 250 enough? Could it be 500? Does that help in terms of?
I think that's debatable, and I know in a previous discussion there, this raised concern. I don't know if Nikita is here, but I think staff's preference would have been to have a higher limit or no limit, frankly. But
Not no limit, but
flexibility. Wait a second.
We trust you guys.
Wait a second. Wait a second. We're going. No, Michael, all kidding aside, this is a question that came up in the prep call. So why don't we allow Tad to comment a little bit, and it's certainly something we can revisit once we get our sea legs here. Tad?
To the 250 million level that was proposed, I think it was deemed reasonable in that it was above existing activity. I think in past couple of years, 150's kind of been the upper range, so that allowed for some upscaling. But while we're removing a kind of risk control of the process, we thought that 250 still kept some guardrails, some training wheels on at higher level type transactions. And so it would capture outsized transactions. But as the program grows and average transaction gets higher, this is something we'll have to revisit. But I think it was enough to, remove for the current going forward practice, but also had some upper bound to maintain some of that risk management process.
So you're comfortable?
Yeah.
Thank you, Mr. Gunning. Thank you, Ted. Any other questions? Seeing none, I think we'll take a roll call vote. It's been moved and properly seconded.
Harry, I also want to thank Rob and George, who actually did all the work on this. So. Someone noted I did all the talking. They did all the work. Thank you, guys.
Thank you.
Ms. Carroll.
Aye.
Ms. Gallegos?
Aye.
Mr. Tang?
Aye.
Ms. Yamamoto?
Aye.
Ms. Bradford?
Yes.
Ms. Hendricks?
Yes.
Mr. Gunning?
Aye.
Ms. Sanders?
Aye.
Mr. Henning?
Aye.
Would you care to vote, Chair Kelly?
Aye.
The motion passes.
Thank you, sir. Thank you. Before we break for lunch, there's the consent agenda information. Would you refresh my memory, Lamont or Alex? Do we have to take action on these? On these information? The information one we don't, right?
Not in the information, but yes, the other
Okay.
6,
So-
7, and 8.
Thank you. Does anyone want to pull any of the consent items? Okay, seeing none. Consent agenda action without objection. Okay, so it's been approved. Brings us to item number 9, information request. Alex, do we have any information requests?
The one that I have down here was earlier, that staff was going to look into the labor dispute issues impacting Cardenas Market.
Yes,
in the
thank you,
Apollo
sir.
Fund.
Yep, thank you very much.
Report back.
Thank you.
Yep.
Appreciate that. And then, and that request, because it's a specific manager, specific issue, we're going to request, and obviously we go through council, that would be reported to us in closed session as to the nature of our conversations with our partners. Thank you. Item 10, the draft agenda for the next committee meeting. Anything we want to highlight, Scott, in particular?
No, I mean, the one thing I think is really important, I mentioned this, the annual cost report will be in November. I think that's going to be a big highlight. Certainly going to be one of the big three agenda items.
Good, terrific. Okay, good. So that brings us to the end of our open session.
We can also remove number 5. Since we approved the private equity investment policy already, so we can remove number 5 from the draft agenda.
Oh, okay, yeah,
Yeah.
thank you, Sharon.
Sure.
Yeah, so for the next meeting, that doesn't have to come back.
Yep.
So we're going to break for lunch for an hour, and we'll come back at, what is that? 1:45? Yeah, 1:45, we'll meet in closed session here. Okay, thank you, everyone.